Welcome to Everything Money. We're glad you stopped by. If you're a new investor, new to the market, maybe you're an older person and you just started investing, that's all great news, and we're glad you found our channel. We want to talk about how to value these companies. All too often, you're seeing videos out there about just stock prices. You buy it at one price and you hope it goes up. There's a lot more into investing and investing in these companies. Paul's going to describe that when you're buying a stock, you're buying a company. So we devised an 8-pillar system, an 8-pillar analysis to look at companies to say, well, what are they worth? What's underneath the hood? So we can come up with a value for this company and find if these stock prices are overpriced or under. We always want to buy low. Unfortunately, a lot of the YouTubers are cheering you on, perhaps, to buy when the market's high. So with all this said, one of our key pillars is free cash flow, and is it growing year to year? I present to you Paul Gabriel, the seer of seers, a man who has a portfolio of $1 gajillion, many Mexico homes, mansions, and cars. The women love him. Guys love him. He's very famous in the Akron area, which doesn't count for much.
In the Richfield subset Glencairn area.
And so we're gonna talk about free cash flow and how you should look at it when buying some of these companies. Would you look at it, Paul? Go ahead. Go ahead, Paul. Tell us about why you love this so much.
So a lot of people look at the earnings of a company, which is really important to look at. But the thing you have to remember about earnings is it's highly confusing because the IRS and the SEC will have different rules for how you report certain income. Cash flow, on the other hand, is more concrete. Is it easy to manipulate? I mean, you can manipulate anything in the investment world, but it's cash in and cash out. So what is free cash flow? You'll hear this all the time. Free cash flow is cash from operations less your capital expenditures. So what does that mean? Cash from the cash flow statement has 3 sections. There's the operating cash flow statement, the investing cash flow statement, and the financing cash flow statement. When we talk about free cash flow, we're going to be focusing on the operating cash flow statement and the investing one. Cash from operations is right here. It's the very last line of the operating cash flow section. What it basically says is, if I were operating the business itself, how much cash did it generate? Now, what do you take out of there? That's not free cash flow. That's the first line. The next line is capital expenditures. That's the very first line of the investing section of the cash flow statement. Now, what we have done with our software is we added this line to make it easy for our users who paid less than $1 a day for access to this entire software. And we just put in here the actual free cash flow year to year. And then we give you a 5-year average. That's one of the pillars in there. What is the capital expenditure? So the capital expenditures, there are 2 types of capital expenditures that companies have. There's the maintenance type. Now that doesn't actually mean like fixing toilets and things like that, but it can be. And there's the growth part. On smaller and younger companies, this should be a bigger part. If they're building factories in order to increase sales, if they're doing things at a major level, not making acquisitions because you use the free cash flow for that, but the growth part is about building more things to increase sales. Maintenance is things like redoing an entire factory line in order to keep the sales going, but a little more efficiently. So maintenance on a bigger company is going to be pretty much the entire capital expenditure part. Companies should break it out in their 10K, but they usually don't. So unfortunately, you basically have to assume that all of these capital expenditures on the investing section are all maintenance. So you take, very simply, the cash from operations, and you subtract the capital expenditures. And that is very easily your free cash flow. Now, what does free cash flow do? Uncle Seth, I used to ask you this question all the time. You never got it right until 8 months into our channel.
I might not get it right yet, but having an excess free cash flow allows you to spend it and do fun things like buy your shares back.
Correct.
Make acquisitions or new companies like AT&T is doing with Discovery. Am I right?
No, but not that example. But yes, you do use it for acquisitions. What else do you use it for? Pay dividends?
Pay dividends, right.
Pay down debt?
Oh, okay.
So these are 4 major things that a company can use with a free cash flow. I like to focus on free cash flow because it's a non-manipulate. It's a harder manipulation of the numbers. It's a cash in, cash out. Okay? At the end of the day, a stock is going to be based on the present value of its future cash flow, right? So if a company has $1, then 2, then 3, then 4, then 5, versus another company has this. every year, which one are you going to pay more for?
The top one?
The top one, right? Because they have an increasing free cash flow, it's larger, et cetera. So as the cash flow increases, you want to be able to pay more for that company, right? Now, guys, a company I always like to bring up as an example is Microsoft, because I think Microsoft has a great overall financial statement. I'm not saying you should buy Microsoft because I think it's too expensive. But if you look at their cash flow statements, look at their cash flow over the last let's look over the last 10 years, right? Last 10 years, 27, 27, 23, 26, 24, 28, 33, 33, 43, 53. They just have, it was a little stagnant in the early 2000s, but they were spending a lot more money. If you look at these years at first, and now they have these free cash flow growing as they get more market share. They're getting a lot with the cloud, doing things like that. So a company like Microsoft with growing free cash flow is a lot more attractive than, let's say, a company like, let's look at BlackBerry. BlackBerry is kind of coming back from the dead, maybe. We'll see. Let's look at BlackBerry's free cash flow over the last 10 years. Ready? Negative 207, 880, negative 1.5 billion, 305, 155, negative 293, 659, 51, negative 18, 38. Where's the consistency here? It's decreasing. I don't know how to explain it other than when I look at free cash flow, in any investment, I want reliability of free cash flow. It doesn't mean I ignore a company that doesn't have reliable cash flow, but if it's reliable and growing, it's worth a lot more to me than if it's all over the place. I have to guess which year we're going to be in. Okay?
If you've made it this far in the video, you should be congratulated because a lot of YouTubers out there just simply talk about the price. So again, we buy a stock at a certain price, and then we must hope it goes up, and then someone else buys it from us in the future. So if you made it this far, congratulations. We're actually looking at the numbers behind the company. So Paul, how do we translate this free cash into determining what we want to pay for these businesses?
So over long periods of time, there are certain multiples that come into mind. So if you have a company that generates $10 of free cash flow a year for the rest of your life, let's say forever, it'll generate $10 a year in free cash flow.
Or okay. 10 million or 10 billion.
Whatever the number is, it doesn't matter. How much you willing to pay? If I told you right now that you'll get $10 a year for the rest of your life, what are you willing to pay me for it?
I don't know.
That's called annuity, right? An annuity is a payment over a long period of time that's consistent. Would you pay 100, Seth?
Yes.
Why is that?
Well, the rest of my life, I mean, it seems like it would be hopefully more than 10 years, so that would be a great deal. I mean,
yeah, you're making about 10% of your money.
Okay.
And by the way, let's assume for the rest of the time, you can transfer it on to your kids, you can give it to your spouse, etc. You're gonna make about 10% of your money.
Yeah.
Would you pay 1,000?
Oh boy.
If it's $10 the rest of your life, the rest of the time.
I don't think so.
No, you're making a 1% return on that money.
Okay.
Of course not. So that's the question we have to ask. As simple as this is the important part. Go back to our example earlier, Seth. If you had a company that was generating 1, then 2, then 3, then 4, then 5, and went up forever versus 1, 1, 1, 1, 1. Let's just say for 5 years. So for the next 5 years, you're buying a cash for the next 5 years. This is $15. This is $5. What do you want to pay to get $15 over the next 5 years?
Well, I think anything less than 15 would be a good deal, right?
I don't know if it's necessarily a good deal.
Not anything. You're right. Okay.
Paying 14 for it, I mean, you're going to make...
With the risk of this not happening.
Yeah. If your projection, even if you knew it was going to happen, are you willing to make $1 if you're willing to invest in $14 to make $1 more?
No, not
No, I can probably do better by paying down my debt of my house, right?
Yeah.
That's the world of investing. Determine how much you want to pay. What happens currently in the investing world is everybody sees this and they go, I will pay whatever it takes to get this because it's growing. Other people see this and say, oh, this is boring. I'm not going to pay anything. Let me ask you a question, guys. Would you pay $1 to get $1 a year for the next 5 years?
Yeah.
Would you pay $20 to get $15 over the next 5 years? That's what's happening today. People are overpaying for future growth. And when we look at the free cash flow growth, it's about understanding where it's going and what people value the company at as a ratio of it, okay? So if a company right here, if you're valuing it at $20 and it's only going to get 15 over the next 5 years, why is that a good thing? I don't know. But you might also look at it like the example I always give is, I looked at Tupperware a year ago. And I was like, I got scared. I was like, man, they're selling so cheap. Their free cash flow is like one per year. You could buy the company for 1 year free cash flow.
Wow.
Now it's at $40 or whatever. It's like $30 right now. It was at $1.50 when I looked at it. And I was just like, maybe I'm missing something. And I got scared and didn't do more due diligence to figure it out. So everybody, whenever you pay for a stock price, you are changing this price paid. This cash flow number probably won't change, but this price is changing.
And let's not get confused with this. We're not talking about paying for the stock price, like the ticker symbol, what it is today. We're talking about the market cap, Paul.
Which is in relation to stock price.
Yeah. So how does all this translate to what I pay for a stock? I mean, this is one part of our...
You want to pay as little as possible for every share of revenue and profit and free cash flow. That would be your goal. If I offered you a basket of 20 companies that had free cash flow every year of 100 and another 20 companies that had a cash flow of $20, let's assume, by the way, that they're very similar growth prospects of the future. Okay? Which one do you want to pay more for? The one that's going to generate $100 a year in free cash flow or 20?
It's obvious.
It's obvious. But we get caught up in individual companies. You look at a company like ARK Investments. I would like to look at the free cash flow of the top 20 holdings they have. We looked at their earnings. 17 did not make money. Currently don't make money. 3 do. And I'm willing to bet the ones that don't make money probably don't have very good free cash flow, if at all, any free cash flow. Because over long periods of time, free cash flow and earnings should be pretty similar to each other. And a company should be able to generate good free cash flow on its invested capital. And when it does that, you make a very good amount of money. This is not very popular during hype times like today. During hype times that everybody's making money just by buying ticker symbols and watching them go up. It seems antiquated. But these companies are also issuing more shares, cutting it all up. It ends up being a recipe for disaster. So what I ask you to do is realize this makes sense. You live your personal life the exact same way. If your free cash flow in your personal life increases, will you be worth less or more? Now, as your free cash flow prospects grow, do you feel like you're going to be more valuable now? Of course you will. But I think I'm going to be a billionaire in 20 years. Does that mean I spend like a billionaire today? No, I haven't done it yet. Don't give me the value. If somebody offered me right today $2 billion for the first $2 billion of my net worth, I would gladly give it to them. They're going to give it to me today? Fine, I'll take it. Give me the $2 billion right now. That's what we're doing. That is exactly what we're doing in the markets when we buy Tesla, Amazon, all these companies at these high levels. You're paying them 10 years from now's price, but today. That's the thing that's messed up.
This is just one of our 8-pillar analysis. We factor in a lot of other things. We've done other videos about PE ratio, profit margin, shares outstanding, talking about revenue and profit growth. And so we'll translate this multiple and this free cash flow into a desired market cap when we start picking the companies. It's a long road, folks. This is a different sort of lonely path if you follow us. And so, but if this resonates with you, we'd love to have you on our team. The software that Paul was using is available to all of our patrons. If you have a hard time, if these numbers speak to you and you have a hard time tracking them down on Google, Y Charts or Yahoo Finance, as a patron, you get the software and much more. So, yeah, Paul, that's our take on free cash flow, an incredibly important pillar for us. And it's like I said, it's always refreshing for you to analyze some of these companies, not just by, actually, you didn't talk about stock prices at all. I mean, really, none of it plays into this, right?
Yep, not right now.
Yeah. All right, guys, that's our show. Thanks for watching. Tickle a thumbs up on the way out. Appreciate it.